Are we good to start? Okay, this is the broad structure of the topic. So we would look at the three types of post-employment benefits. Okay, let me just spend some time on the basics. This topic is primarily about what benefits you would be giving to your employees once they retire. Okay, so the whole intuition behind this topic is that let's say this is where you recruit your employee. Now he's going to work for you for next 30 years. Now when he retires, at this stage you would want to compensate him. So this compensation in most of the cases would be pension. So let's say that you would be paying him a lump sum pension of 50 lakhs a year. Now this 50 lakhs should not be recognized cost in year 30 because you've incurred this cost of 50 lakhs because he's worked for you for all these years, right? So we use simple matching concept and then we try to figure out that how much of this 50 is cost here, how much of 50 is cost here. So you have some cost. So let's assume that in year 1 through some mechanism you figured out that your cost was 1 lakh rupee. Now the question is that this 1 lakh is your expenditure, but are you paying it in cash today? You're not, which means that you would also have a liability of 1 lakh. Next year your expenditure was 1.5 lakh. Your liability is 2.5 lakhs. Next year your expenditure is 2 lakhs. Your liability is 4.5 lakh. In this fashion your liability would reach to 50 lakhs and then you would pay off the 50 lakhs and liability would become 0. So this is what this topic is about. So you look at the three types of post-employment benefits. Then we would spend some time on defined benefit plan obligations. Okay, so this is the broad outline, but we'll directly jump on to the topic. First one is defined contribution plan, which is extremely straightforward. Okay, so what it means is you have an employee, you are going to give him pension. So what you do is you tell him that my contribution per month or per annum is fixed, that I am going to pay you 5,000 rupees every month. You take care of your pension. So once I give you this 5,000, then it is your responsibility to make sure that you invest it properly. It is your responsibility to ensure that it grows to a stage where it would take care of your pension requirements. So since my contribution is defined, not the benefit that employee is receiving from you, it's called as defined contribution. Straightforward accounting, this 5,000 is your expenditure. Your cash will reduce by 5,000. There would be no asset, there would be no liability. Income statement, 5,000 is your expenditure. Balance sheet treatment, your cash will reduce by 5,000 and the investment risk lies with the employee. Are we okay here? Should we move on? Defined benefit plan, this is where things become complicated. Okay. So what you promise your employee is the amount of pension that he would receive at the end of 30 years or 40 years. And since you promised him an amount of pension, you would have to make sure that you are investing sufficient amount every year so that you receive or you have that level of portfolio at the end of 30 years from now. So here in this case the amount of benefit which is to be given to the employee is being assured. So it is the employer now who would be required to assume that investment risk. Employer would be required to estimate the future value of liability because the exact amount of pension outflow that will be paid 30 years from now, we do not know that as of now, right? So we'll make a guess out of it. There would be a number of variables which are required to be assumed. Now these variables would typically be that if you want to know this pension, then you'll have to make certain assumptions as to at what rate your assets is going to grow, right? And most of the cases this pension would be dependent on how many number of years your employee would work for you, how many years that employee would be alive from the date of retirement. So you'll have to make certain assumptions like mortality, assumptions like by what amount his salary is going to grow every year. So these are the variables that you're going to assume. Separate assets are maintained against the liability. So you would create a separate pension asset account. And then if your assets are greater than the present value of liability currently, then we would say your plan is overfunded. And then these are the other category of post-employment benefit plans, which is mostly healthcare. Okay. So if you have to divide all the post-benefit plans for level 2 into 3 categories, one is defined contribution, other one is defined benefit, and the last one is for healthcare. In defined contribution, the amount that you're paying is constant. In benefit, the amount that you've promised your employees given, and in healthcare, generally you promise in certain amount of benefits related to the healthcare. Should we move on? Yes, no. This is an example. You can probably write this one down. Yes, have you followed the logic? That you are promising him 3 years of his annual salary for every year of completed service. So if he's worked for you for 20 years, his final salary is 1 lakh, then 1 lakh into 3% into 20, 60,000 is the annual pension that you're going to pay him. And this amount of pension will be paid to him every year from his retirement till the time he is alive. Okay. And therefore you do not exactly know how many number of years you would be required to pay, so you'll have to make certain simplifying assumptions. Should we move on now? Now we'll come on to the defined benefit plan obligation. Okay, so we'll do an excellent example here. This defined benefit is based on present value of liability, which is to be calculated on expected future salary increase. We are going to assume that employee will work till the time he retires. Where is the example here? This is the example. Ashwin was hired on January 108. He was promised an annual payment of 2% of his annual salary multiplied by the number of years of completed service. His starting salary is 50,000, discount rate 8%, compensation growth rate 4%. He will work for 25 years. He will live for 15 years after retirement. That means he will receive 15 payments. Calculate PBO, which is actually the liability on account of pension in year 2008 and 2009. So again you will have to use the same logic. First step would be find out his final salary. Then with his final salary multiplied with 2%, and then that you multiply with number of years of service that he is offered, and then this amount is to be paid to him for 15 years, and then discount all these cash flows backward for 25 years. Yes, how much is the liability? 2008. Sorry? 3460. Correct. Calculate for 2009. This is the amount of liability in 2008, but whether we have to pay it or not, we don't have to pay anything as of now. We have to pay 25 years from now. But the payment that I have to make 25 years from now, that liability today is 3460. So ideally we should also create an asset of 3460. 7473. Yes, good. Should we do this together? Tanay, you got the answers? Okay. See, step number 1, calculate last salary. Okay. So, what is your current salary? 50,000. He's going to work for 25 years. Every year it's going to grow by 4%. So, while calculating the final salary, your N is going to be 24 years. Because when someone works for 25 years, he gets 24 increments. So, first thing that we do is we calculate the final salary. Second, clear TVM. 50,000 is the present value. 24 is the N, 4 is the IY, compute future value. So how much is the last salary? 128, 165. Once you have this last salary, calculate 2% of that. How much? 2563. Then this last salary is to be multiplied with number of years of service offered. So we will keep 2563 as the payment and 15 is the N. What was the IY? 8%, and then compute present value. So that present value would turn out to be how much? And then that present value would be the value that I will have at the end of 25 years. So again you would bring it backwards, but while discounting it backwards, you will discount it only for 24 years because you want to know the value of liability at the end of year 1. So I think we should have it somewhere here, correct. 128,165, 2563, 2563, 21940, this is 25th year, and then when you discount it backwards for 24 years, it should be 3460. So this 3460 is called as your PBO, present benefit obligation, the amount of liability on account of pension expense. Now to find out for 2009, this is where we'll be required to multiply with number of years of service, which is 2. So 128,165 same, 2563 same, but now we multiply 2563 with 2, which will give you 5126, and then using the same process now we will assume 15 payments, but while discounting it backwards here, now you will discount for 23 years, so it will give you 7473. Are you clear? It was 8%. No. 4% was used only to find out this. That's the compensation growth rate. After that, you will discount with 8%. Now see, once you have this expenditure for 2008, sorry, liability for 2008, and you have liability for 2009. Okay, so it was 3460, and from 3460 it has become 7473. So let's calculate the difference by which the liability has increased. The liability has increased by 40 4013. So this increase in liability of 4013 must be your expenditure, because the amount by which your liability increases is your expenditure. And this 4013 is made of two parts. Okay. The first one is interest and the second one is pension expense. So only because of time value of money that liability is going to increase. So how much was your original liability? 3460. 3460 into 8% is 276. This is the amount of interest expense. And second, that instead of 2563 per year, now in next year you would be paying pension of 5126. That means you are paying incremental 2563. Incremental 2563 for 15 years. Incremental 2563 for 15 years discounted backwards to year 2. If you take that amount, that would be your pension expenditure. In fact, let's do this together. Keep 2563 as the payment, 15 as the N, 8 as the IY, compute present value. Store this in the first memory slot. Second, clear TVM. RCL1 is your future value, 23 is your N, 8 is your IY, compute present value. How much is that? 23736. Is that correct? So now take total of 3736 plus 276. It would be 4013. So how has your liability increased? Your liability has increased because your employee worked for 1 extra year. So your amount of pension that you have to pay him has increased, plus your liability also increased because of time value of money, because of the interest cost. So now if you look at this, that factors causing changes in PBO, which is your liability, that one extra cost, the pension expense amount by which liability increased, that was called as current service cost. So present value of benefit earned by the employee in the current period. Then we will also have the interest cost. Now there might be a past service cost where you've changed some of your plans, or if you've made changes in your actual assumptions, and it would reduce by the amount of liability which is being paid off, which is benefits paid. Yes, are you clear? So again, opening liability will increase by pension expense for this year, which would be called as current service cost, or I would avoid the term pension expense. But the increase in liability because employee worked for 1 more year. It will also increase because of interest. It might increase or it will increase if you decide to change some of your plan. So means you originally promised your employee that I'll pay you 2% of final salary, but then later on you decided to make it 3%. So generally this amount would always be a positive number, okay, because you cannot change your plan in such a way which will have negative impact to the employee pension. That means this amount would always be positive, it would increase your liability. And then changes in actuarial assumptions, that originally you assumed that an employee would work for 15 years when he retires, but then you thought that no, now he would work probably 20 years or 25 years. So that's a change in actuarial assumption. And then finally, if some of your employees retired this year and you paid off the pension, then there would be benefits paid. You want to ask something, Shraddha? Benefits is you have a liability of 100, you pay back 20, you're left with 80. So you have some liability and few of the employees retired, so you paid back those benefits. Are we clear? So PBO calculations, beginning PBO plus current service cost plus interest plus planned amendments plus or minus actual gains or losses minus benefits paid is the obligation at the end of the period. Okay. So yeah, this method is called as projected units credit methods. So in case if you just want to know the name of the method. Now this was the composition of this increase. 4013 was made of 277 and it was made of 3736. Then why would this happen? Okay. All right. Sorry? Oh, okay.
The doubt was that
is it shrinking?
Yeah, it was.
Yes.
If the expected return on plan assets affects the pension expense.
Expected return on plan assets affects pension expense.
So then why does it not affect PBO?
Because PBO we don't worry about expected return on assets. In fact, on PBO we do not worry about return on any assets, neither actual neither expected. Yeah. PBO is a liability, returns is going to be your assets. You maintain a liability which is separate, you maintain an asset which is separate. There is no interest expense. Yeah. Okay. Interest cost. Yes. No.
So, but that PPO part, actual or expected return, that even if it goes to UCI or income statement, that's okay, but it's still a part of PPO, right? And the difference between your.
When that part comes, do you remember there was a difference between IFRS and US GAAP? So, when that part comes, we'll deal with it, but it wouldn't affect your PBO. We'll understand why. Alright, defined benefit plan, balance sheet presentation. This part, if you want to write, you can write it down. And you always report it as a single line item. If it's underfunded, it would be a liability. If it's overfunded, it would be an asset. And then this is something which is extra. You have an asset, and this asset has become more because the actual return on assets were higher than what you originally estimated. So your liability is, let's say, 200, your assets is currently 300, so differential is 100. But now, because you have an excess asset of 100, in future your amount of contribution that you are required to make is going to be lesser. So when you show that excess asset, there is going to be a cap on that. That cap would be that instead of 20 now, my contribution every year is going to be 15. So that differential of reduced contribution is 5. I will take present value of all those 5. So it's just an accounting restriction over the fact that you don't want to show an excess pension asset. Right? So this is conservatism, that though as of now your assets are substantially higher, but in terms of your reduced contribution, how much is the amount by which your contribution will reduce? You take present value of those amounts. Are we good to move on? Yeah, it makes sense. It makes sense.
I mean, what does conservatism mean? You're trying to save tax.
No. Conservatism means that you show assets at a lesser value and liabilities at a larger values.
So that would be that.
No, that has got nothing to do with taxes. That is got with that with assets you want to be really conservative, whereas with liabilities you want to recognize them as quickly as possible. So we are just putting upper cap on the amount of assets that we have. Taxes has got nothing to do here.
In reduced contribution and refund, we is one and the same thing.
Depending on what is the structure, I mean, there might be a scenario where in fact you are not making any contributions at all, but you are receiving refunds. That means that your value of assets have already increased beyond, okay, let me put it this way, that your liability is 80, your assets are 120, so excess value is 40, but now your funding would stop. So that means now you would not be required to make any funding whatsoever because the plan is mature. So that your reduced contribution are approximately, let us say 30, which you had originally planned. So you take present value of those 30 and then that would be the amount that you would show on your asset. Lesser amount. The difference between the two, asset or liability, excess of asset vis-a-vis present value of reduced contributions. So okay, so you would not be expected to calculate this, but in case if there is one line which says that present value of reduced contribution is this much, then the one which is lower out of the two, that amount you would be required to show as the asset. Okay. So this has got PBO of 12,000, fair value of assets as 9,000. ABC has got PBO of 6,000, fair value of assets 10,000. And fair value, present value of available future refunds or contribution is 2000. Calculate amount or asset or liability reported by XYZ and ABC on balance sheet. So for XYZ it would be 3000 of liability. For ABC it would be 2000 of assets. So I think with notes you can just write it down from someone else who's written it earlier. This will be able to save time. Okay. Yeah, this thing you can make down. Might be helpful. So write it down. Yes, you can ask your question now, Tamishri.
Yeah, that's the question. So, the interest cost in the PBO, that is not, is it the net interest expense is not? So, it will only be getting.
Because if it's net interest, it's actually never going to grow. If you take net interest, your discount rate and expected return is same. So that means the interest cost would always be zero. Interest income would be calculated on How will be what?
How will it be? I mean, mention expense comprises of these three components, right? Service cost, net interest expense or income, and remeasurement. So, net interest expense or income component is, I mean, what you're saying is that is just beginning TBO multiplied by the discount rate. It is not actually the net figure, which is why.
No, that's the confusion is happening because you are assuming that interest cost we would be calculating at actual return. The interest cost that we calculate at PBO, you are assuming that we will calculate at actual return. We will not. No, the amount by which your liability increases. The amount by which your liability increases, that will not have anything to do with returns whatsoever. PBOs.
Okay, so then how does the expected return on assets affect pension expense?
Expected return on
Plan assets. How does it affect pension expense?
pension expense or pension cost.
How does it?
These are different. Expense is accounting expense. Pension cost is economic cost. So if you are asking pension cost, it does not. If you are asking pension expense, it does. Are you done writing so that I'll explain this? Alright, see. Your pension expense in IFRS is made of these components. Now, with IFRS, there is one thing that you need to remember, that your discount rate is exactly equal to expected return. That means what we generally do is that on the assets that we would be creating, on that asset we would have some actual amount of return. So in year 1 you might have 10%, year 2 you have 15%. But if you take those actual returns directly, then it might increase the variability of your pension expense substantially. So instead of taking the actual return, we take one expected rate of return. Okay, so to calculate pension expense, I would take my expected return on plan assets. So what happens because of that is that I might have a difference between my expected return and actual return. That difference I would transfer here. Okay, which is difference between expected return and actual return. Now see, first component of my expenditure was service cost. And this service cost is again made of two parts. First one was current service cost. Second one is past service cost, which is result of your planned amendment. Then the next component of your pension expense is made of net interest expense or income. So if the plan is overfunded, then you are going to have a net income. If the plan is underfunded, then you are going to have a net expense. Can you tell me why? Yes, because your rate is same. Your expected return and cost is same. So if there are more assets, then you would get a positive return on them. If there are more liabilities, then that would be an interest expense. That means in this case, I shouldn't have said pension, I should have said interest amount is netted. Are you following the intuition here? And then the last part is your remeasurement, where you would have actual gains or losses. This is a part of your remeasurement, and differences between expected return and actual return. Now this part is expensed directly in profit and loss account. This part is expensed into profit and loss account, and this part is recognized in OCI, but it is not amortized in IFRS to profit and loss account.
So all these things also affect TBO, right? Service cost will affect it.
Yes, service cost, yes.
Interest cost will add even actual gains and losses also.
Yes.
So I mean, how do you decide whether it is affecting PBO or not affecting?
Because you should know, see, with PBO it's fairly straightforward logic. PBO will increase by your service cost. PBO is a liability. So when you earn return on something, is it going to increase it? You have a liability, you have a set of assets. Okay, so when you earn return on those assets, is it going to reduce your liability? No. Of course, the net asset or net liability on your balance sheet would affect, but a pure liability because of what returns you're earning is not going to be affected. Are you following this? Because if you're not charging interest to your PBO, it would never turn out to be that big amount that you originally thought it would be. In our example, it was about 3563, whereas on 25 years that amount was about 60,000. So if you're not loading up the interest, your PBO would remain at 3,000 even on year 25, isn't it? So you have to load up interest there. Return on assets will increase. I'm not saying it would not. Return on assets would increase your assets. So it would affect your net pension liability or assets. It would affect the funded status, but not the expected return, the actual returns. Because funded status is asset minus liability. So actual asset would be affected by the actual returns, not the expected returns.
Again, netting of the interest also we have here. So interest is also one of the returns on the assets.
Yes.
So if it is more than expected return, the expectation will be okay.
See, it's like I assumed a discount rate of 8%. Okay. I have liability of 100, I have assets of 100. So on this liability, my interest cost is 8. On this asset, my interest income is 8. This is not a real income, mind you. I have expected a return of 8%. So my net interest cost is 0. So here it would be 0 on my profit and loss account. But actual return on my assets was 10. So I have actually earned a return of 2 extra. So those 2 extra I will take to my OCI. And this would remain in my OCI. With an assumption that it would be a level playing field in future times, it might be vice versa. It might be vice versa and that OCI would be set off immediately.
Like particular plan assets is affecting the pension expense through the net interest expense component, right?
Repeat your question. Slightly louder.
The particular plan assets is affecting the pension expense.
Yes.
Because of the net interest.
Expected return on plan assets anyways will affect your pension expense.
Yeah.
It will. Discounted. Expected return is your discount rate in IFRS.
But PPO grows by the pension expense only, right?
No, not all components of pension expense. This is okay. If it's your flowchart, I should call this as pension related expense. See, not necessary that all these are directly increasing your liability, but these are all pension related expense. Because I have a pension liability, I have an interest cost. Because I have a pension liability, I have an asset, and on that asset I have an interest income. So, expected return on assets is not going to affect my liability in any way. It would affect only my assets. No, in fact, not even assets, only my pension expense. Expected return wouldn't affect your assets. Painful, yeah.
Then the interest, whichever is out of liability, if that is lower than the expected interest return, then I take it as income in
If my assets are more than my liability, then I would take as an income in my profit and loss account.
But that will be only expected return will be considered.
Expected return. On your profit and loss account, actual return does not go. Expected return goes. So that actual return, the difference between the two, goes to your OCI. See, ultimately net effect is same. Your balance sheet is going to tally. Because if there is an income, you would transfer that to equity. If there is a loss, you would show that as a negative number on equity. So effect is same, but you are smoothing your income here. So you are avoiding that variability. Are we clear? Did we solve questions on pension in the class? I think there were a few questions, right? Actually, we solved Shweta, is it? Okay. This is US gap. Write down the flowchart. There's too much of stuff to write. Are we done here? So see, in US GAAP again, current service cost will go to P&L. Past service cost would directly go to your OCI, whereas in IFRS, past service cost was expensed. Now this would be amortized directly over the remaining service life. There is two different types of amortization that happens in US GAAP. One is the corridor method and one is this direct amortization. Then this interest expense will go to your profit and loss account. Now this remeasurement part would be recognized in P&L or OCI and then amortized to P&L using the corridor method. Okay, which means that you can expect a significant amount of volatility in US GAAP income statement because this entire actuarial gains and losses can be recognized in P&L. Or if you recognize them in OCI, then you will amortize them using corridor method. Okay, so these are the guidelines which will help you and tell you when do you want to amortize it. But as far as past service cost is concerned, you don't have any such restriction. The moment it goes to your OCI, you will start amortizing it. So even though there are amortization in both the cases, with past service costs you will amortize it directly, whereas with remeasurement you would amortize it after you've met those corridor levels. It can be recognized in P&L directly or it can be recognized in OCI and then amortized using corridor. Both the methods are allowed.
Interest expenses expected on that.
This interest expense is reported separately.
That is,
Liability into the discount rate.
that will always be on expected rate.
नहीं, discount rate anyways is an expected rate ना. एक discount rate तो होगा ही. IFRS में आपका जो प्लान एसेट्स है उस पर एक्सपेक्टेड रिटर्न था, वो IFRS में सेम था, मतलब जो डिस्काउंट रेट होगा वही एक्सपेक्टेड रिटर्न, दैट वुड बी योर एक्सपेक्टेड रिटर्न. इन यूएस गैप दिस कैन बी डिफरेंट. सो इन IFRS वी डिड नेटिंग, income minus expenditure for reporting purpose. Here we would be showing them separately. Okay, so it might happen that your expected return on assets are 10% and your discount rate is 8%. So you will show your expense separately, you will show your income separately. But again, on the income statement, we are not having actual income, we are having expected income. No, it's not in choices. Are we good to move on? Now this is the corridor method. If the cumulative actual gains or losses are more than 10% of greater of plan assets or liability, then the amount in OCI should be amortized over expected average remaining lives of the employees. Okay, just that there are too many small things that you would have to remember here.
People will again do say you want to expense or OCI. As the man says, if you choose one method, you have to go to OCI right. I mean, variability, is it because of change between P&L and OCI?
Variability because if it goes to P&L in one particular year, the amount of profit or loss because of change in actual assumption can be very high. So that high amount of profit or high amount of loss might change your profit or loss substantially. Now I haven't read anywhere where it says that once it's in OCI it should always be in OCI. So I don't think there is any such restriction, but might be. But I don't think so there should be such thing. There should be such thing. If you amortize, yes, but if you put them into profit and loss account, it would increase it, because the amount of actual gain or losses would be substantially higher. Okay. Alright, plan assets 10,000, PBO 8,000, average working life 10 years. Actual losses in OCI are 3,000. Since 3,000 is greater than 10% of 10,000 or 8,000, which is in this case 1,000, we would be amortizing it, and we would amortize every year 3,000 divided by 10. The amount of amortization would be 300. Are we clear? Do you want to write this down? Do you write it down from someone else? Okay, write it down.
So,
This is corridor method.
so in the book, what it says is you will not amortize 300. You will amortize only the excess amount above your above the corridor. So it will be only 200 that will come.
You would amortize only the
Amount in excess of the corridor. So it will be only the 2,000 that will amortize.
You will amortize 300 every year. You will stop when it reaches 1,000. No, but the amount of amortization every year would be different. If we say 2,000 divided by 10, it would turn out to be 200. We would amortize 300 every year till the time it reaches 1,000. Why? Because it must have been done on an assumption that OCI would keep on changing every year and assets would also keep on changing every year. So you keep on amortizing it, you stop to a level where you've reached less than 10%. That means you stop to a level where you've reached 10%. But till the time you don't reach, you keep on amortizing it. Which makes sense. Yeah. So which makes sense that you stop to a level where it has come to 1,000. Are we okay? Okay. Assumptions and analytical treatments. So which all assumptions do we have to make? Discount rate, rate of compensation growth, and expected return on plan assets. So if the discount rate is increased, what would be the impact on PBO? PBO will decrease because your discount factor is now higher. What would be the impact on current service cost? Current service cost. Will it increase or decrease? Louder. Sorry? No impact. Take a look.
Defined plan. No, defined plan will be an impact.
We are on defined plan. Condition is gone. So this entire discussion that was there last 10 2 slides was all defined benefit plan.
So we'll reduce it.
See, service cost is what? That incremental pension that you paid, that pension discounted backwards. So when you will be discounting backwards with a higher discount rate, your current service cost will decrease. Are we following this? Yes or no? And then interest expense. Assume US GAAP. Assume US GAAP. So it's common sense, there's no rocket science here. See, though your discount rate is increased with which you would be multiplying to find out interest cost, won't your liability decrease substantially? Yes, depending on whether it's a mature plan or a young plan. So when it's a young plan, what would be the impact? It would decrease. And if it's a mature plan, it will increase. Why? Because when your discounted increases, with a mature plan, increase in interest cost is higher than decrease in liability. See, there are compensating impact. What's happening is, you have a PBO. PBO into discount rate is your interest cost. So when you increase this discount rate has now increased. But assuming a young plan, this PBO will decrease substantially. Young plan means naya plan. So the amount of PBO is smaller. So since your liability is smaller, with a smaller liability you are multiplying with a higher discount rate compared to a level playing scenario before this. So your interest rate in this case will decrease. Are you following this? And vice versa, that had this plan been mature, then this PBO would be a substantially larger amount. And with substantially larger amount, you would be multiplying with a higher interest rate, so it would increase the overall cost. You follow this? But don't remember, think from a logical perspective here. You want to ask something?
Service cost would be a small amount.
Yes. No, it would be a very high amount. The reason why, just a minute, the reason why service cost would be a very high amount, in this case we were discounting it backwards for 23 years. But with a mature plan, we would be discounting it backward only for 1 or 2 years. So the service cost, and it makes sense because that extra number of years for which the employee is working is 1 year every year, but now you are discounting it backwards only for 1 or 2 years compared to 23. Yes, you were saying something, Dhanush. Same thing. Are we good to move on? If compensation growth rate is decreased, what would be the impact on PBO? PBO will decrease. This was easy, which is obvious because last salary would decrease. What would be the impact on current service cost? Decrease, isn't it? And what would be the impact on interest rate? No impact. They've got nothing to do with each other. If
interest cost would be
interest?
No.
What you said is correct. Interest cost, assuming US GAAP, will decrease because PBO will decrease. But this says interest rate. Because in IFRS we cannot say whether it would increase or decrease, because we do not. In IFRS we also need to know the level of assets. In IFRS the amount is netted. So if we have a overfunded status, it's complicated, forget it. It's not think too much, because even if it's an overfunded status, with a decrease in, I don't want to think so much. I'm already a bit tired today. Yeah, this is expected return on plan assets. Yes, pension expense. Decrease. Okay, because to find out pension expense, we reduced expected return on plan assets, not the actual. PBO. Good. And funded status? No impact. Because funded status is what? Asset minus liability. It's neither affecting your liability, neither affecting your assets. These are expected returns, not actual. Are we good to move on? Alright, now this is called as economic pension expense. Very importantly, please remember this, that economic pension expense in your curriculum has been referred as economic pension cost, or in fact simply pension cost. So if they use the word cost, it means an economic expense. And if they use the word economic expense, if they use the word pension expense, it means accounting expense. And of course, that reported pension expense is a smoothened number because we use expected return as against actual returns. So hence we calculate economic pension by eliminating that smoothing, and there are alternative ways of calculating this economic pension. So these are the three possible ways. Number one, service cost plus interest cost plus planned amendments minus actual returns. Are we done? Do you want me to explain you, or can I assume that you've already understood? Part 1, we want to find out the economic cost or we want to find out pension cost or economic expense. Service cost is a true cost, add that to interest. Plan change, so add that cost here, and then reduce the actual return. Okay, so first one is straightforward. Second one is nothing but the first one, written in a different fashion. So changes in your PBO, and changes in your PBO is what? Service plus interest plus planned amendments minus the contributions paid. So adjust that for the contributions paid except the benefits paid, and then reduce the actual return on assets. Same thing. Is this making sense? And now the last one, ending funded status minus beginning funded status. Okay. So this again, ending funded status minus beginning is the difference of two assets, and difference of two liabilities. Now on difference of the two assets is made of actual return on assets and the contributions made, and difference of two liabilities is made of all those things which are part of my economic cost. So in this formula, I anyways have differences of my two liabilities, which is my cost. I have differences of two assets, which is my actual return and contribution. I just adjust for contribution. So automatically it would give me the same thing. Because you would invest some amount in your assets every year. That's your contribution, but that's not your return. That is to be eliminated here.
But it does not matter if you take contribution minus this value for that line, for the books of contribution minus the
Yeah, on the
but that it says that depends on funded status to take assets or but so
have I given you a flowchart on the weekdays batch? I made a flowchart on this. Yes, sorry, weekdays. When we did it in the regular session, I made a flowchart out of this. Just take your notes. Is there a flowchart? Yes. So refer to that flowchart and share it with others. So this will tell you how is the funded status being defined and how that is to be calculated. By the way, the way formula is written in Schweitzer is correct. There is nothing wrong with that formula.
so but in that case you take assets minus liabilities are funded status.
Yes. Assets minus liabilities is your funded status. Alright. So calculate economic pension expense for the year using this data. So simply put these numbers and find out the answer. Yes, how much? Okay. See, what information that we do not have here is past service cost. Right? So we first need to check if there is any past service cost that exists in this. So opening PBO 15,000 plus service cost 12,000 plus interest cost 2,000 minus benefits paid 4,000 27, 29 and 4, 25. So ending PBO is given as 25,000. That means there is no past service cost here. So then what is my economic expense? My economic expense would be 12 plus 2 minus 5. So 14 minus 5, the answer is 9.
So if you go by the second formula, changes the PBO, so that will be 10,000.
Yes.
10,000 minus actual return.
10,000 adjusted for the benefits paid, which is 4,000, minus the actual return on asset, which is 4,000. So 14,000 minus 5,000 would be 9,000 again.
This 4,000 benefits paid will reduce the PBO.
Yes. So we need to add it back.
So 9 plus 4.
So we need to add it back so that we get this spread. 14,000. Heavy? Changes in PBO is how much? 10,000. Contributions are 4,000. So 10,000 plus 4,000, 14 minus 5, 9,000. Are we okay? Yes, Mr. Bhupendi. Not comfortable, not clear. See, it's really simple. There is no rocket science here. What is happening for accounting purposes? In fact, let's calculate the accounting expense. Okay. So how is accounting expense calculated? Service cost 12,000, interest cost 2,000, plus there is no prior service cost, so there is no plus, minus the expected return on assets, which is 3,000. So your accounting expense here is 11,000. But you want to find out the economic cost or pension cost. So you would say that this is correct, this is logical, this is the amount by which my liability should increase. This is also correct. But I should not be deducting expected, because that's an assumed number. I should be deducting the actual return, which is how much? 5. So I'm writing this plus 0 and I'm writing minus 5, so which would give you 9. So then why am I making sure that I write 9 here? That there might have been a scenario. If I just tell these numbers, instead of 25, if I make this as 27,000. Okay. So what it means in that case is, you would say opening PBO 15k plus service cost 12k plus interest cost 2k plus prior service cost x minus benefits paid 5 is closing, which is 27. So 27, 29, 29 minus 5, 24, 24 plus x is equal to 27. That means prior service cost is 27, 29, 29 minus, prior service cost is 3. It should have been 2. Are we making mistake somewhere? 15, 12, benefit paid kahan pe 4, sorry. This is 4. So 27, yes. So then prior service cost is coming out to be 2000. And then in that case, we would be required to fill in this 2000 here to find out the true economic pension cost. Are we clear? Okay, this is painful. Alright, so write down. I think I did not do this part in the regular batch. Yes, are we good to move on? Okay, now this is something which is important from exam perspective. So you can assume that you would find at least one question from here, because your curriculum is full of questions from this particular topic. See, ideally what should happen is that your economic pension expense is what you should contribute to the pension fund, which is logical. So not the accounting expense, but what was your economic expense, that is the amount by which you should contribute to your pension fund so that that asset grows automatically. Now, if your contribution is more, okay, then differences net of tax should be treated as cash flow from financing activities outflow. You would view as prepaying your loan, okay, because otherwise you would show it as a cash flow from operating activities. Is the intuition clear? That your cost is 50, but you invest assets of 70. Why? So that you are trying to prepay that liability that you have of 20. So that difference, extra 20 to be adjusted for taxes, would be viewed as outflow from cash flow from financing activity, and since you deduct it from CFF, you would have to add it to cash flow from operations activity. Okay, so be very careful that there would definitely be a case on pensions on the exam, and if there is a case, there would definitely be a question on this particular point, right? And generally this would be the case that a person would pay less or a person would pay more. So if he's paying more, then it's an outflow from CFF, and if he's paying less, it's going to be an inflow from CFF. We are going to assume that he's taken that amount of loan to pay back that amount, and you'll have to adjust that in operations. So if it's vice versa, it would be treated as CFF inflow. Are we okay here? Okay, moving on. Alright. Now this is relatively easy. Accounting for stock options. Calculate fair value of options, which is not intrinsic value. This fair value you will calculate using yes, you would either use BSM or you would use binomial. Okay. And then allocate the compensation expense over the service period of the employee. Even if the options are not exercised, compensation expense will remain the same, which is important from the exam perspective. That once you find out the fair value of that option, employee is going to work for 5 years, divided by 5 is your expenditure every year. If the options are not exercised, what happens to that? No, that would still be there. See, options are not exercised means probably these are not so beneficial. These are not so beneficial, and if these are not so beneficial, automatically the fair value that you would calculate would turn out to be very low. So that effect is automatically captured into that. But from an accounting perspective, if you are issuing options to your employees, then you would give him that benefit that he would exercise it. So that benefit you need to expense out over the period of 4 to 5 years, or whatever is the service period for which you are allowing him to exercise it. So you don't reverse that effect, that remains. Are we good to move on? Least accurate. Okay, now word here is cost. That means we want to find out economic expense. Yes, the answer is B, because funded status adjusted for contributions. A is correct, this plus this plus this minus this. D is correct. It's more volatile because actual returns would be more volatile. The answer is B. Increasing the discount rate, because it says lower leverage. Lower leverage means lesser debt, and lesser debt means lesser liability of PBO. So when you increase your discount rate, your PBO will reduce, which will reduce your leverage ratio. Your service cost will reduce, your interest cost will reduce, which will increase your profitability. In case of C,
Interest cost to reduce.
yes. In case of, is it clear?
So PBO is reducing, but interest is increasing.
But interest cost will still reduce. It's a new plan. Yes, it says that. Are we okay? Option number C. Increasing growth rate in compensation expense would increase your liability, which is not going to serve the purpose. Increasing expected return on plan assets would only increase your profitability. It would not affect your leverages. Should we move on? They are basically teaching you how to manipulate by asking this question. Yes, what is the answer? C is the answer. And when you increase the discount rate, PBO will reduce, service cost will reduce. When you reduce the compensation growth rate, automatically PBO will reduce, service cost will further reduce. Increasing discount rate was correct, but increasing compensation growth rate was not correct. Increase in expected rate of return was correct, but okay, this was actually not correct. Or is it correct? Oh, this is expected rate of return. So, assuming US GAAP, this might be incorrect. But C would always be correct.
Service cost component of interest expense.
मतलब service cost जो था आपका, वो you want to reduce that service cost. So that service cost will reduce automatically if that incremental pension amount is lesser. And if that incremental pension amount is lesser, if your compensation growth rate is lower, or if you're discounting backwards at a higher rate.
So, expected rate of return will not affect your.
Expected rate of return will not affect the service cost in US GAAP. In IFRS, a higher expected rate of return would mean higher discount rate, which would lower your service cost. Because in IFRS these are same. Should we move on?